prices increasing like, say, $300 a week, depending upon the speed, and then you're only able to save $100. Each week you're actually getting further and further behind.
Correct.
When looking to get in the market. So you could see people's frustrations at the minute.
Going once, going twice, sold. You're listening to the Property Pod.
Hello, everybody. You're listening to the Property Pod, your weekly accessible access into the Tasmanian property market and hopefully beyond. We don't know. We'll do our best. But we are mixing it up today a little bit because we've got a really cool report to cover, and you'll notice a different voice opening up this time round. Rather than our resident expert, Aaron, he is still the master control of the camera and the voices, etc., and noise control. So hopefully get it right. But it's a bit of a fun change-up because we've got a lot of stuff happening this week in the office, which we'll cover off another time. But most importantly, I think it's a hat we need to cover off, Aaron, because we are today sponsored by the Sorrento Paint Team, my man Joe. So the good thing is, don't worry, mate, you'll be back for next week when we cover off all things good and exquisite painting by Joe Sorrento. I'll try and drop it as much as I can, mate, but we'll do our best. So joined in the studio today, commenting is my father, an expert and real estate legend in Tassie, Chris McGregor. Say hi, Dad, if you feel like it.
Great to be here. Thank you, John.
And, of course, Sam Allwright, our new member, and it's really excited to have you on the mic again, mate. So
Yeah, thanks, John. Love to be here.
yeah, thanks for joining the team. So today what we've got is the REIA has released their new housing affordability report for Australia-wide. So we know we threw you out both under the bus a little bit by quickly having to get a skim over the report. But, I mean, one of the most interesting things about this then is that over the last 20 years it's commenting on, quite simply, the affordability for property in Australia for Australians from Tasmania to Sydney, covering all the states.
It's quite a good snapshot. I'm impressed to have a read of it.
Yeah, and I suppose the good thing about having you in as well, Dad, was that this is covering from 2001, but obviously you've been operating in the industry a lot longer prior to that as well. So it'll be interesting to hear, I suppose, the differences that you experienced both as an operator and homeowner as well.
Yeah, no, we can cover that.
I mean, so to cover off a couple of things, just pragmatically, is there's three measures that the housing report covered. So I'll just quickly give the definitions and then we can just get stuck into it. So the first measure used was housing and rental affordability trend. So they described that as the housing affordability takes the average home loan for that state or territory at the time for owner-occupiers and establishes the monthly repayments. So just the monthly repayments, and then these are based on a 25-year loan term at the standard variable interest rate. So then it says the rent-to-buy differential. So the rent-to-buy differential looks at the differential regarding the proportion of family income required to meet home loan repayments and rental repayments. So how much does it cost to buy a house versus how much it costs to rent a house?
Yeah.
And then lastly, the average home loan amounts percentage of first home buyers. So average home loans indicate the average new loan for owner-occupiers is recorded by the lending indicators from the Australian Bureau of Statistics. Average first home buyer loan amounts are from the same source. It should be noted that average home loan amounts include first home buyers. So then I suppose, so what that is effectively saying, what is the percentage of new buyers entering the market at any one time?
Yeah.
So obviously there's a heap more dance in this report and we'll make this available in the show notes. First off, gentlemen, what are you, anything that popped into your mind when you're quickly skimming over this morning?
From my point of view, as a bit of a newbie, I suppose, I was quite interested to see the average loan amount jump up quite considerably from, what was it, roughly 86,000 to 384. I think they were saying there's an increase of close to 342% over 20 years, which is just phenomenal.
Yeah, and obviously that's, specifically focused on Tasmania as well with those numbers.
I mean, obviously, average salary incomes have increased, those sort of things as well, but I don't think they've increased 350% in 20 years.
Yeah.
It's a big chunk.
Well, it shows the difference between Australia, 2021 is 548, 323, and in Tasmania it's 384, 525. So we're still have quite a significant cheaper amount that we're borrowing on a loan compared to Australia. We're comparing states like New South Wales and Victoria. But when you consider one of the things I'm looking at is the interest rates come down so far over those years, which has given people an opportunity to borrow more money, but they're actually borrowing more than they were with percentage to their loan than they were in much earlier days.
See, that's something that I just couldn't answer. That's what got me is like, why? Why is it that, like in Tasmania specifically, in 2001, it says the proportion of family income devoted to meeting an average home loan repayments were 18%.
Yeah.
And then from 2006, 2011, 2016, 2021, it says 30% or a third, 36, 25, and then 31. So why is it that we just with interest rates are we just conditioned now that because the banks allow us to borrow 30% or perceive that to be a reasonable repayment, is that then we just borrow it because we can?
It's sort of become the new target.
Yeah, it's like, well, like you said, Dad, it's if interest rates are low and you've got access to the cash, you just borrow what you can.
I think there's a mixture of all those, what you just mentioned, John. There was a lot of cases where you'd have people go into the bank for a loan and they'd lend you a lot more than you believed you could afford.
Yeah.
And that's when the Royal Commission come in. But the other thing is also too, people's wants and needs are very different. What people need and what they want are two different things, aren't they?
Yeah, yeah.
And a lot of the times in the buying decision, they used to say the decision based on a need is 5%, and what people want is 95%.
Yeah,
so it's quite a massive difference.
So I suppose right now I did notice a trend after my time spent in the industry is the expectation of first home buyers on an average. We're never going to say that's always true, but I do notice that the expectations of first home buyers of what they will often want in a new home, be it an established home or a new home, seems to be a lot higher than it was perhaps 30 years ago, because because money's easier to borrow. We're like, well, I want all those flash stuff that my parents have right now. Whereas realistically, I often will say, look, your first home doesn't need to be your last home. Yeah. So don't feel like you have to stretch yourself to every little degree, because you will get all the things you want. You might just have to sacrifice a few things for today.
Yeah.
What sort of the difference you've noticed, Dad, in that behaviour, from prior to 2001 to now?
Well, when we first purchased the things around 1985, something like that it was, and houses at the time were about $30,000 in Glenorchy, and between $30,000 and $50,000. But the interest rate at the time was about 8%, and you'd always you could get about 5% deposit at the time. Then so you'd always get the much smaller loan, and in our situation, we just wanted to get in the swimming lane. We just wanted to get into the market.
Yeah.
Where and we were happy to take second-hand furniture from the parents and all those sort of things and grab what we could. But today, sometimes it's hard for the new generation comes in looking at the home. They look at their parents' home when they want to leave home. They want one exactly the same. So their expectations are a lot higher. Which can be hard. So, and I had a lot of people that if they didn't like a particular area they wanted to live in, they would just go and rent. They wanted to live in Sandy Bay, so they rent in Sandy Bay, or other people would go out and purchase in Glenorchy, northern suburbs, and down the track, the ones that purchased in an area that they probably didn't particularly want to live in, but it got them into the market, are better off than the ones that want to say, I just want to live in this particular area by renting.
Yeah.
That makes sense.
And I remember my brother looked at a unit. It was just a little two-bedroom unit in Moona, $41,000. He said, but it's just a little unit. I said, yes, but it gets you into the market. It's only $41,000. He then sold that for an extra $10,000, purchased a home for 50-something thousand, sold that for 75, then moved to Melbourne, bought for 110, sold for 300, and so forth, and kept. And he's in a beautiful big home now in Otago. But he wouldn't have been able to do that if he hadn't have started in the first place by just compromising on what you're going to buy.
So what would you say to, people that are going, well, it's easy for you to say because houses were cheaper back then. And
yes, but I was on $5,000 a year too.
See, yeah. So that's interesting. So that's where they're talking about that proportion of income. Because, I mean, obviously you could look back and go, well, you know, you could have, well, why don't you just buy 100 homes because they were so cheap? Well, obviously the stress, I assume, on the household was exactly the same, as it is now.
And we're going to be saying that in 20 years' time too, when people are buying, we just sold a place in Dowson's Point for $700,000, but we should be saying, well, I should have bought 5.
Yeah.
But you can't.
Yeah. Well, because when did you buy your first home, Sam? Can you remember?
Oh, probably would have been in my mid-20s.
About mid-20s?
Up in Launceston.
So what was your experience for you personally at that time? So what year were we talking about there?
Oh, going back now, probably late 90s.
Okay.
Yeah.
Yep.
Late 90s, early 2000s. Ended up, we were renting for probably about 4 years and then just decided to get into the market. So we bought a place that wasn't 100% to our liking. It was a little bit further out of Launceston than we would have liked. Like, we made a few sacrifices.
Yep.
It was never going to be our long-term house. We always envisioned to move back to Hobart with the family and friends.
Yep.
We made a few sacrifices. It was a nice place. We made it our own. But, yeah, back in those times, you just made do with what you could.
Can you remember... because obviously when we're trying to fit a timeline back to the report, because we've got as early as 2001, but not prior to that. Now, in that report in 2001, it was saying that the proportion of family income devoted to meeting the average loan repayments was 18%. So, and then when it came to proportion of family income devoted to meeting median rents, it was 21%. So, 1/5 of our income at the time. Yeah. Can you remember the setup? I know it's a hard question, but the setup when it came to dealing with the mortgage, can you remember the deposit, etc., that you'd organised at the time?
Yeah, our rent at the time was quite low.
Okay.
We, on purpose, rented a very small, cheap place so we could devote as much money as we could to a deposit. So we had that goal moving to Launceston, that for a couple of years we would do it tough to make sure we could afford that deposit to buy a property.
Interesting,
Yeah, and then once we got into the property, we had a nice little chunk going towards that. But as you're aware, I still like a few toys and motorbikes and things.
As we all do.
A bit of that did bleed off into that area.
Yep.
We certainly didn't borrow as much as what we could have. We just made a smart choice and realised that this would be a house for us for 2 or 3 years until we moved back down.
Yeah, see that's an interesting point.
It was a 2 to 5 year goal, honestly. Yeah.
So so you mean in terms of saving for that deposit and purchasing, or knowing you'd buy and then move on again?
The whole thing from front to back. So 2 years of saving for the deposit, then purchasing the house, staying there for about 3 years, trying to purchase in a smart area, something we could do a little bit of fixing up on, but not a huge amount.
Yeah.
Not the handiest of persons, if I'm honest.
Me either.
And then basically moved back to Hobart. It was always that sort of 5 year goal.
Yeah. Okay. Well, see, I think an interesting story that you've got there was we rented to save money. So we're at the time
we had to sacrifice our rental ideals in order to save money.
Okay. Interesting again. So so you weren't living in the area you really loved and trying to save. You were legitimately renting out an area that you knew you could afford. Correct. So you could save. See, okay, so that's an interesting distinction again, because there's that sort of discussion a lot around the rent vesting. So you've purchased a home in an area that you wouldn't necessarily want to live in.
Yeah, correct.
So you're in the market, and then you go and rent in an area which you want to live in because you want that lifestyle now, but you don't want to wait 15, 20 years in order to get there. So I know we had one of our guests write in some time ago where she'd said that the challenge for her at the moment is obviously because the rents have increased proportionally as well, as it in order to support a family, she's sort of in a tough situation where she's trying to rent, but she doesn't have enough money to put away. And obviously in the market at the moment is that with before we found that prices increasing like say $300 a week depending upon the speed, and then you're only able to save $100 each week. You're actually getting further and further behind.
Correct.
When looking to get in the market, so you could see people's frustrations at the minute.
It's probably a bit controversial too, but you've got to look at sometimes at people's lifestyle choices. I mean, you only have to go to the supermarket and look at some people's trolleys, and you'll see 15 cans of Coke and lollies and all those sort of things. And probably if you're saving up for a home, probably could call those unnecessary. And then, of course, you see 15 cans of Dog Pal and all those sort of things, and people love their pets. Of course. They're great, but at the same time, they're an expense. And sometimes, like when we saving for our first home, just as we're just about getting to the tweak of our deposit to have enough, we were eating popcorn on weekends, literally, to get that enough to get that deposit. So and I've tried to help people into homes for many years ago, where they were smoking 2 packets each, almost a day, and to buy this particular home was $500 a month. Well, they were spending more than that on cigarettes. I said, well, if you stop smoking the cigarettes, we can get you into this home. And other times we'd have ones where they've got a car that has got quite high repayments on it, which of course that gets in the way of getting a home loan as well, because the bank takes into account other loans you've got. And you look at a house that they really like, and the guy turns around and says, I'm not selling the Commodore. So then you're sitting there, well, how can you help these people if they're not going to help themselves?
Yeah, I think it's true, but it's not a message that people really like to talk about. But that is what it is. If how do you get wealthy? Well, you spend less than you earn, and that, I suppose, what you're talking about, that is sacrifices.
Yeah, I've got a friend in South Australia that, and he said he's finding it difficult to get into the market, yet he's got himself a brand new car. He bought a motorbike. He's thinking about looking at getting a boat.
Yeah.
I mean, where's the priorities?
Yeah. What do you genuinely want?
Well, what you said before is that you had your toys and stuff like that at the time, but I mean there are toys proportionate to your income, because I know a friend of mine, when he got a job in the mines, he used to buy $50 pairs of jeans.
Yeah.
Then all of a sudden he started spending $500 on jeans and realised that he actually had no more money than he once before, but he just he bought more expensive things because he was earning 3-4 times as much. And then after the 12 months, when he realised what he was doing, he completely reconfigured his lifestyle so that then he increased his capacity to earn a higher income, and then vastly decreased his living expenses until such time as a 5 to 10 year plan to reset himself. And I guess the hard pills to swallow isn't exactly it's not a popular message. It's not nice to hear, but it's the only practical solution sometimes.
Well, it's pretty much what I went through with my house purchase, and the most recent one that I'm in now down at South Arm.
Yeah, tell us about that.
We had that desire to live down near the beach. We just love that acreage, that sort of lifestyle, just, get away from the general population. And I just say, I love my cars, I love my motorbikes. I had a V8 Ute I ran in Targa and all things like this. They all got sold. I think I kept one motorbike and one car. The whole fleet disappeared.
All of it gone.
All gone. Had to purchase the house we wanted. What's the best for our family moving forward? Yeah. That's what we did.
Yeah.
The fleet's slowly building up, but nowhere near what it used to be. But at the same token, I don't regret that decision. It's a beautiful place to live.
There you go. And look, see, one thing about this report that I suppose it interests me is that as much as we're in theory paying more for houses, and I know one of the risks that it said here was once before that to purchase an average home was maybe 3 times the family's average income. Now it's getting to 6 to 8 times, which is a scary statistic in many ways, and it makes me wonder though, is that on a day-to-day basis, where it's talking about how much it's always cost to live versus what your income, history's never changed. So it's always been the same of about, say, 30% up and down. And like your experience, Dad, where, it's all well and good to say, well, houses were cheaper for you back then, but you still couldn't buy 10 houses at once because
the interest rates were so high.
Yeah.
And they got to 17.5% by the around 1990. And we purchased a second home, which we went from 8% to about 14%, and then I bought an investment property, and then when the interest rates on the house went to 17.5%, and then the investment went to 21%. I ended up top salesperson for the state for that year because just to keep the 2 houses.
I needed to eat.
Yeah.
Well, I mean, there's a couple of big questions that made me think that sort of wrapped. I'd love to get a better perspective on someone much smarter than me. Specifically, is why is it 30%? Why is it and also too then has it been a relaxation on what the bank is allowed to lend out to people? Is it the lower interest rates and saying, look, you're allowed to still borrow it to 95%, but because money's so cheap, now we can lend out so much, and so the houses just keep chasing what people are prepared to pay because the banks will lend out the money. I don't know,
Well, when we first got our homes, the loans were always about 25% of your income, and I noticed it's gone up to about 30%.
Yeah.
But they worked that out because for all the other outside of expenses to live. Because you're going to have your car, you got your family, you got maintenance, you got taxes, all those sort of things that come into that account for you to be able to afford. Because once you start going over that, it really does eat into your lifestyle.
Yeah, absolutely. All right, boys, we'll wrap it up there. Thanks for
Thank you.
Thanks for shotgunning in at the last minute, knowing they dumped that report under your noses rather quickly. But more importantly, I suppose, in looking at the report, I wanted your experience.
Yeah.
So we'll have Aaron back on the lead next time. Thanks for sponsoring the show, Joe. We'll have you back again, and send us more hats, mate. It's not fair that only Aaron gets one. That's not how it rolls here.
But I hope your microphone works next week, Aaron.
Yeah. Always a pleasure, boys, and thanks for joining us.
Thank you.
Done.
You have been listening to The Property Pod, recorded and edited by 414 Media House in conjunction with 414 Property Code.
This podcast is general information only, and the thoughts and views expressed is the opinion of our panel, and listeners should always seek and use their own investigation into any topic we discuss to ensure they fully understand their own situation.
It does not constitute and should not be relied on as purchasing, selling, financial or investment advice or recommendations, express or implied, and it should not be used as an invitation to take up any agent or investment services. No investment decision or activity should be undertaken on the basis of this information without first seeking qualified and professional advice.